Okay, I'm going to present something slightly different now. This is uranium. It's all in Africa. Our total focus is on development, cautionary statements. Goviex was founded in 2007. It was initially focused on the Timisoy Basin in Niger, one of the largest uranium basins in the world. We've taken that all the way forward to a fully mine-permitted project. We've got one of the largest resource bases now in uranium, having acquired projects in Zambia and in Mali, and we now have 2 fully permitted projects. We've got a strong development pipeline. We've been working on the debt. We've been working on the offtake. We also have a very interesting group of investors who tie this whole company together. It is only in Africa. We have focused solely there, mainly because you can get things done in Africa. If you want to play this market, the largest transactions that were done, the quickest mines to production have always been out of Africa. Its ability to get permits committed and development through. The 3 of the largest transactions in the last cycle were all in Africa, were all well over $1 billion. 2 of them were over $2 billion. They're actually smaller companies than we're currently in our position now. The highest returning project for you as an investor in the last cycle was in Africa as well. That was Paladin, who built 2 mines in Africa in the last cycle. They went from 7 cents to $7.50 in 2 years, which is a pretty damn good return. Through all our drilling, we've done over 650,000 meters of drilling in Niger, right with all the infrastructure. We've got roads, power, water, we've got people. We've got a government who relies on 60% of its exports being in uranium. Very strong position for development there. In Zambia, we've got a government who wants to diversify from their current developments in copper, looking for development in the south of the country. We are in the south with the uranium project fully permitted. One of the other issues for us is that we have only drilled very small parts of all of our projects. In Niger, when we went over 120 million pounds of uranium, we decided that was quite big enough already. There was no point in making it 200 million pounds. If you've already got a 21-year mine life potential, it's not going to lot for your net present value. In the case of Niger, we've got over 11 years currently as a planned mine life. It could be more than doubled in both properties. And we'll do that when the market starts to pick up. And I think that's starting to see that now. If you look at the market, it is really starting to change. Since 2011, we've had all the pressures post-Fukushima. We had oversupply coming in that was trying to build for the greater tomorrow that was there in 2011. But over the last few years, you've seen return to nuclear power. Nuclear power generation globally is now back above the 2011 position. You've had a steady trend of growth. We're now at the fastest rate of reactor builds for the last 25 years. A lot of Western government particularly are realizing they have to have around about 20% of nuclear generation. Europe, Japan, the US is about 18%, and you've seen the new rules, expect direction given by the Trump government protecting coal and nuclear going forward. But the biggest change has really been coming around in the last 6 to 9 months. We've been waiting the market to tighten up. We had inventory. Those inventories are being pulled down. Last year's inventories for the US were down on the previous year. Europe has already been declining on inventory. The more important fact was that Cameco last year decided to shut the best uranium mine in the world when it would have been making money. Their logic was, why bother digging it out of the ground if I can buy it cheaper in the spot market? This market needs to tighten up. So they took 18 million pounds of uranium, 10% of world production, off the market completely. When it happened, what we said on our side was don't expect it to hit the price yet. Why? Because they had 25 million pounds of inventory. They were going to sell their inventory down first. That is what Cameco has been doing. They're now making it clear that when they get their inventory level down to about 13 million pounds, they will be in the market to buy and fill their contracts going forward. Cameco's book is about $40 to $50 a pound uranium. That's what they need to replace their resources for long term. They need to get those contracts back at those levels. So you will see them buying in the market to push that price up. But more importantly, what you've then seen is what we've all been waiting for is the correction on production. You saw Paladin announce a closure of their Langer Heinrich project. That's important because about 4 million pounds per annum coming off there. Why is that important? Because Paladin happens to be the largest spot seller on the independents. So you're about to see Cameco entering the market looking for spot material as one of the spot sellers actually disappears from the market. Another of the spot sellers has come out and indicated, which is Kazakhstan, that's going from 23,000 tons of uranium down to 21,500 tons of uranium. Another big change coming through to the market. And lastly, we're expecting in October, around that time, Orano to shut the Cominac mine, which is next door to us, which has been going since 1971, which is about another 4 million tons. So you're starting to see this kick into the price now. So I think in the second half of this year, we're already in a supply deficit. What Cameco is going to be doing is squeezing on the market inventories. We have had production cuts across the whole side. If you come to my booth afterwards, I can answer questions. That is now really starting to come through. What you then have is the issue that at the end of the day, if you're looking at new supply coming on side, with the exception of Cameco restarting McArthur River, there is nothing that can really come back unless you see uranium prices well over $50. They're the only ones who will, and it's very clear what their strategy is. They want the price back up to that level anyway, and they'll stay out of the market until that time. But at the same time, the covered contracts, the long-term contracts, which the reactors rely on, is coming off very sharply. And at the same time, we're seeing inventory levels dropping on the major utilities. So where does that put us? Goviex is all about development. We've been getting our projects ready so that when the market turns, we're ready to build. So both Madawiela and Matanga, one in Niger and one in Zambia, are both fully permitted and ready to be built. We've been getting them ready for the market to turn. In Madawiela, this is a 21-year mine life. Cash cost is forecast at $25 a pound. That's the same as an ISR project in North America. The difference is this is 21 years, not 8 years. It is fully permitted. The resource here is over 100 million pounds of uranium. Reserves are currently at 60. This could be more than doubled. Why? Because we're up dip from Arriva's mines, the Orano mines. We just literally have to keep drilling towards their project. We're in the same ore body. So all the infrastructure's there, roads, power, rail, people, water. A government, who I said, is very driven to get us up and producing. Why? Because they need the tax revenues off the back of this. What we've been doing now as well is, as I said, getting ready. Optimization, we've been looking at a lot of things that we can do to the current PFS as we go into the DFS. We've looked at things like membrane separation, which allows us to recycle a lot of our consumables, things like sulfuric acid, phosphoric acid, to reduce our capital. The impact of membrane separation would basically bring our cost down by another 10% and reduce our capex by about another 6%. That's got to be worked into the DFS. We've acquired more, recovered back previous licenses that we had to give up under the mining code. That's added another 5 million pounds of reserves of up-dip, open-pittable material. So those will work through. We've been working on debt. We've shown people, a few years ago, I used to present and say, well, how are you going to finance a Nigerian project? We're financing it with debt and equity. Why? Because the export credit agencies are more than happy to finance on the debt in this market. So we have two export credit agencies providing the overlay and 4 debt financiers underneath. We've also been working on the offtake, and the equity side we'll deal with later. Matanga, very simple, open pit heap leach operation, $120 million. All-in cost is exactly the same as you got at Madawiela. The difference is a slightly higher OPEX here. But what it does for Goviex, though, is we can structure Madawiela very much under a controlled collared contract, and we've still got the leverage sitting down at Matanga. Most of my peers have only got 1 project. We have 3 projects in our pipeline, which makes us very different from our peer group. We've got a management team who've been in multiple commodities in multiple countries. We've been in this industry a long time. I worked in every continent except Antarctica, and most of the commodities as well at one stage of my time, and same as Rob Bauer. And a board that is very much structured around changing this company. We changed it about 3 years ago from being an exploration company to a development company. We've changed management, we've changed the board to suit the style of company that we're working with. There is our current investment holding position. Valuation, despite having a very large resource, a fully permitted project, we're really not seeing that value. We've seen this before. This is exactly what happened to Paladin. It leveraged round. The de-risk came through when the market turned and the metal price ran, and Paladin ran. So expect the same thing to come. We outperform on the uranium price upside. Thank you very much.